Hello, good day. Numerous investors believe in and use the principles of technical analysis. The fact is, the large investment houses provide extensive support for technical analysis, and a large proportion of the discussion related to security markets in the media is based on a technical view of the market. How does technical analysis differ from fundamental analysis? What are the underlying assumptions of technical analysis? What are the major advantages and challenges to technical analysis? If you are curious about the answers to these questions, watch this video. The objective of this video is to help students understand the basic philosophy and reasoning behind technical analysis. It introduces and gives an overview of technical analysis. Let's learn together. Technical analysis attempts to exploit recurring and predictable patterns in stock prices. Technical analysts or technicians are sometimes called chartists because they study records or charts of past price movements of the stock market and individual stocks. Technical analysis involves the examination of historical market data such as prices and volume of trading to estimate future price trends for investment decisions. Technical analysis seeks to uncover trends in market prices, which is in effect a search for momentum. Technical analysts use data from the market itself because they contend that the market is its own best predictor. Some experts believe that studying the market should be the major ingredient in the stock selection process. Therefore, technical analysis is important. It is the market that matters, not individual companies. Technical analysis is the study of the various forces at work in the market and their effect on the stock prices. If the capital market is weak form efficient, then prices fully reflect all relevant market information. So technical trading systems that depend only on past trading data cannot have any value. By the time the information is public, the price adjustment has taken place. Therefore, a purchase or sale using a technical trading rule should not generate abnormal returns after taking account of risk and transaction costs. If the market efficiency theory is correct, technical analysis should not work at all. The prevailing market price should reflect all information, including past price movements. The key to successful technical analysis is a sluggish response of stock prices to fundamental supply and demand factors. This prerequisite is opposed to the notion of an efficient market. How technical analysis started? Analyzing market behavior dates back to the 18,000s, when there was no such thing as industry or company analysis. Detailed financial information about individual companies simply was not available to stockholders, let alone the general public. About the only thing investors could study was the market itself. Some investors used detailed charts to monitor what large market operators were doing. These charts were intended to show when major buyers were moving into or out of particular stocks, and to provide information useful for profitable buy and sell decisions. Technical analysis is based on a number of basic assumptions. First, the market value is determined solely by the interaction of demand and supply. Demand and supply are governed by numerous rational and irrational factors. Technical analysts believe that changes in the short-run demand and supply for a stock cause prices to change. Disregarding minor fluctuations in the market, the prices for individual securities tend to move in trends, which persist for long periods. Prevailing trends change in reaction to shifts in supply and demand relationships. These shifts, no matter why they occur, can be detected sooner or later in the action of the market itself. Lastly, technical analysis assumes that many chart patterns tend to repeat themselves. Technical analysts claim that a major advantage of their method is that it is not heavily dependent on financial accounting statements. The technician contends that there are several major problems with accounting statements. They lack a great deal of information needed by security analysts. Many psychological factors and other non-quantifiable variables do not appear in financial statements. Examples include employee training and loyalty, customer goodwill, and general investor attitude towards an industry. Most technicians do not invest until the move to the new equilibrium is underway. They contend that they are more likely than a fundamental analyst to experience ideal timing. That is the best time to enter the market. Technical analysis tends to increase trading activity, creating extra costs. The success of a particular trading rule will encourage many investors to adopt it. It is contended that this popularity and the resulting competition will eventually neutralize the technique. Specific trading rules require a great deal of subjective judgment. For example, two technical analysts looking at the same price pattern may arrive at widely different interpretations of what has happened and therefore will come to different investment decisions. The past price patterns or relationships between specific market variables and stock prices may not be repeated in future. Is technical analysis reliable? Some complex patterns may be difficult to define statistically. They are too dependent on the context. It is also possible that belief in Chartism is self-fulfilling. However, many investors using these techniques claim to have experienced superior rates of return on investments. In addition, many newsletter writers base their recommendations on technical analysis. Even the major investment firms that employ many fundamental analysts also employ technical analysts to provide investment advice. Numerous investment professionals and individual investors believe in and use technical trading rules to make their investment decisions. Therefore, investors should still have an understanding of the basic philosophy and reasoning behind technical approaches. Investors have a wide range of choices with respect to technical analysis. The approaches to technical analysis can be classified as the big picture, technical rules and measures, as well as charting. We shall learn more about each technique in future videos. Chartists can be separated into two schools. First, those who read from charts are called pure Chartists or Chartism. Second, those who seek trading rules based on technical indicators and test these rules. They are referred to as statistical technical analysts. The financial database in the university under Thomson Refinitiv consists of 11 technical analysis tools. You are strongly encouraged to learn and use these techniques for stock analysis. You can use the database to look at the most recent technical charts for buy and sell signals. I hope you have learned something from this video. See you and goodbye.